Okay, so we'll get started. Well, again, thank you everyone for joining us on this webinar this afternoon. We are really excited to be hosting this webinar in partnership with Sense Financial, in which we're going to be discussing how to leverage your self-directed 401k or self-directed IRA to invest in real estate. There's going to also be some other avenues you can explore, but this one will mainly focus on real estate and just kind of the setup. So, going back, this was one of the first events that I've actually ever co-hosted. And, it was one of my first few weeks with the company. And, quickly after the presentation, I realized that this was a perfect fit for me. And I worked with Sense Financial and the team to set up, my solo 401k, and I've been very happy with the service and all of the investment options that I've had, within that entity. So it's been awesome. I'd like to, quickly introduce myself. My name is Vince Tomich. I'm an advisor here at Marshall Reddick, and I have been with the company now for just over 5 years. And, I'm a big fan of what I preach. So I am a real estate investor myself. I've actually purchased property within my solo 401k with the help of Sense Financial and Marshall Reddick. I have a background in the mortgage industry. I am a huge fan of investing in rentals. Like I said, I'm here in Southern California, born and raised here, and focusing on Texas and some of the other markets, Florida, Tennessee, that we have a good footprint in. I'll go into some of those markets, but yeah, as an employee, I am also an investor, and that's where I connect with a lot of you folks more on a one-on-one from like an investor level. So it's great to be able to chat with you guys and share some of the information personally done to tie into maybe what you guys are working on. Okay, so for those of you that might be a little newer to Marshall Reddick, I always like to take a minute or two just to explain who we are and what we do. So I would describe Marshall Reddick as a full service real estate firm, and we have 4 primary services that we focus on. So we have our real estate brokerage, our property management, we have our private lending where people can borrow money, and then we have our ability to invest in notes or mortgages. So just to break those down a little bit further, so for real estate brokerage, we help people buy and sell, whether it's a primary residence or an investment property. We can help with that, whether it's located here in Southern California or in one of our markets across the country, specifically Texas, Tennessee, Florida, Kentucky, right? So we can assist with that. Property management. So 9 out of 10 times when we have an investor who purchases an investment property, they are going to need the support of property management. Most of the time, they're not anywhere near the property, nor do they even have the time or bandwidth to deal with managing a property. So we can take on that service. And we handle everything from marketing the property, rent collection, rent disbursement, any kind of repair request or anything dealing with the tenant, we would handle on your behalf. So a little rundown of kind of what that service looks like. And then third, we have we do private money lending. So we have a slew of individuals who borrow money from us. Individuals who are doing fix and flips is a big borrowing group. Individuals who actually own self-directed retirement accounts or solo 401ks. That is another huge portion of our who borrows from us. So again, like tying it back to my personal investment, I have a solo 401k. In order to purchase a property in that entity, you need a non-recourse loan. So that's what private lending offers. So that's another great example of individuals who seek to borrow capital from us. Now, for our investment funds, so there's actually a couple ways you can be a lender. So the same way that people borrow from us, we have investors who want to lend their capital, and you can lend that, directly one-on-one, meaning one borrower and one lender. Or we have an investment fund, which is an awesome way to kind of diversify your risk and spread your capital amongst multiple loans across the country. So you're investing in a pool, right? And in that pool, we, Marshall Reddick, lend that capital out to those borrowers that I was just describing a few moments ago. So that's a little bit about our service. I'm happy to dive into any one of these in more detail, but for those of you that are not as familiar, I wanted to take some time to give you the overview of how we can assist and where we can be of value to you folks. Just being patient here while we move. Okay, so this is just a really quick snapshot of the markets that we operate in. So you'll notice we're in 5 different states across the country. You'll see that we have a highlighted city here, and this is where we actually have like a physical footprint where we can assist, whether it's brokerage or property management. So for those of you that are interested in exploring real estate opportunities or property management, just specifically, these are all areas that we can service and assist. So just wanted to give everybody kind of a quick rundown of what that looks like for those that may be looking outside of California, because as you know, California is not very, it's a bit pricey. So sometimes it's hard to get your hands on an investment property locally, and it makes sense to maybe seek outside of your backyard. And just one more slide before we turn it over to Brett here. I just kind of wanted to quickly explain how we arrived or how we chose those markets. And, we chose to set up our offices in markets that possess, the key criteria that we think support a strong investment purchase. And those are all here for you, to read. So I don't want to read them down the list, but these are all things that we feel are really critical. And we feel that each of the markets that we're in do support, do meet this criteria, and something that has proven to work well, right? We've definitely expanded our footprint in each of these markets, and I have to say it's still looking very, very strong. And with property management getting bigger and bigger and stronger and more resources there, it allows us to better serve you folks when you do decide to explore, the out-of-state investment options. So towards the end of our presentation, what I'm going to do, or should I say post our presentation, you can expect a call from myself, more just to connect, just understand what brought you to the presentation and how we can help. But essentially, I'm just here to set up the who, what, when, where, and why, right? If there's something we can do to help, this call could be as short as a minute and say, hey, I was just tuning in to learn a little bit more, or like, hey, you might have a specific criteria that you want to dive into, and this is kind of what we would go over on our call, right? It's like why you may want to look to purchase, or how, what options, when, what, right, and so on and so forth. So the most important part of my role is introducing you guys to all the key players. So whether it's our agents, our property managers, our partners at Sense Financial to help set up your self-directed accounts, lenders, whatever it may be, that my job is to help facilitate that from A to Z. So yeah, just expect a call from me within the next couple of days or beginning of next week, and we can chat more. But without further ado, I want to turn it over to Brett Synicky with Sense Financial, who's going to be diving into the self-directed retirement account world and how we can leverage our retirement accounts to invest in real estate and some other cool options.
Great, thanks, Vince. Can you hear me okay?
Hear you loud and clear.
Excellent. Yeah, great service that Marshall Reddick offers. In fact, I have been affiliated with them personally for, gosh, almost 20 years now, probably more than 20 years. I think in the early 2000s, I started attending the meetings, bought some real estate investments throughout the country, and I had a great W-2 job back then where anybody who could fog a mirror could get a loan and buy some rental properties, and so I did. And I had those for a long time, and there's a whole story behind the disposition of each one of those properties, but suffice it to say, buying real estate inside of, and I'm going to talk about doing that inside of an investment, or a retirement account rather, but I just want to say it also can make sense to buy real estate outside of a retirement account as well. And so, there's different tax benefits to each, obviously, right? So within a retirement account, you're going to get tax benefits that you don't get outside of the retirement account, and vice versa. And so I will touch more on that but I've been affiliated with Marshall for a long time, and so has Sense Financial as a company. But without further ado, let me get in. So our mission is to help clients obtain control of and protect their retirement accounts. Proverbs 21:5 says, good planning and hard work lead to prosperity. And you work hard for your money. We want to come alongside you and work hard alongside you as well, should you choose to become a client of ours, and just help you to grow your retirement so ultimately you can retire with dignity. Just a quick story. Jason from Tallahassee was one of our clients, still is, and he had, before he met us, an IRA and a 401K valued at around $135,000. He was just invested, as many people are, in the stock market. After he met us, what happened was the market started going down. He did what a lot of people do and shouldn't do, and he pulled all his money out. And so he probably missed out on some of those gains that he would have had when the market went back up. But nevertheless, once he met us, he was able to, he decided to open up a self-directed account with us with checkbook control. We'll talk about that. And he went from really making nothing to losing money, to making nothing because he pulled everything out, to cash flowing about $1,000 a month pretty quickly. He bought a rental property inside of his self-directed IRA, and he invested in a business actually that his brother owned. His brother is and was a serial entrepreneur, and he wanted to invest in one of his businesses, so he did that. And then he loaned money and had a real estate note, and so all that was putting positive cash flow into his account. And so just a little bit of an example of what you can do with this. But before we move on, I just want to talk about the difference between conventional versus self-directed. So, and I apologize, the sun is like coming through my blinds at this time. So if you see like these weird stripes on my face, that's what it is. I'll do my best to kind of stay out of that sunlight. But as time goes on, the sun keeps moving down. I digress. Conventional, which we all know of, right? You open up an IRA or even a 401K through your employer, you have access to what they offer, right? Think Vanguard, Fidelity, T. Rowe Price, Schwab, those kinds of firms. They offer stocks, bonds, and mutual funds primarily, right? So you have access to what they have. On the other side, you have the self-directed accounts. Okay, this is where what we specialize in, and there's virtually no limitations. This list you see here on the right side of your screen is not exhaustive. In fact, and I will share what the IRS says you cannot invest in, but that's all they do. They actually don't tell you what you can invest in. They just say what you can't invest in, and that's because it's a very short list. But some examples, of course, real estate, mortgage notes, trust deeds. Marshall Reddick can help out with either one of those, of course. Private lending, you can actually, if you want to, you can still invest in stocks, mutual funds, if you want to diversify as well in that. International real estate, we have many clients who invest internationally in real estate. Options, and the list goes on. So there's a few different types of self-directed accounts. There's a self-directed IRA custodial account. We don't do that, and I'll share with you kind of why we made that decision. Checkbook IRA, or also known as the IRA LLC, we do. And then we call the self-directed solo 401K the ultimate retirement plan. And I will share with you why we call it that. But first off, what is a self-directed IRA? Well, it's a trust account. It's tax deferred, right? Just like an IRA you have at Vanguard, it's tax deferred. It's held with an approved custodian, and you can invest in non-traditional assets. We gave you a short list of some of the options there, and it's been around since 1974. It's probably so little known, quite frankly, because people who have certified financial advisors they work with don't normally benefit from self-directed IRAs because they're kind of cut out of that, right? If they offer the service, maybe that's a different conversation, but most of them don't. So they go with stocks, bonds, and mutual funds, and that's what they know. And actually, it's not even something that they're keeping from their clients necessarily. It's just they just haven't been exposed to it in a lot of cases. And it allows you to invest in non-traditional assets, true diversification. As I mentioned, the investment returns are all tax deferred, and there's no capital gains on the sale of real estate. Okay, so this is why I mentioned buy real estate inside of the retirement account, buy real estate outside of the retirement account, because inside of the retirement account, it's great. There's no capital gains taxes, right? If I own a rental property in my self-directed IRA and I sell it, well, that money just goes back into my retirement account until it's deployed into another investment, more real estate, whatever. So there's no 1031s. It's not necessary. There's no depreciation recapture tax that you have to pay. There's no depreciation. But that's why I say sometimes it makes sense to hold on your own as well, real estate, because you can take advantage of things like depreciation and all this other stuff. But I'll talk more about that as we go on. And Vince mentioned briefly, if you do use leverage to buy real estate, you can't get just a normal loan. Like you couldn't go to your lender at Loan Depot, for example, and get a regular mortgage. It has to be a non-recourse loan. And non-recourse essentially means you're not putting your personal stake on that loan being paid back, right? It's not your financial situation, it's not your credit, it's not your income. The property has to be the only security for the loan. So that's what that means. And Marshall Reddick offers those as well. And we send many clients to them for non-recourse loans. Excuse me. So here's how the self-directed IRA works. Sorry, they're loading in a little bit of a backwards order. So first off, you open a new account with a custodian. Okay, then you set up a qualified transfer from a current IRA, 401K, 403B, wherever. It can be, the 401K has to be a former employer 401K, but just know that you can transfer that in or roll it over in to the self-directed IRA. And most people, because the IRA annual contributions are $7,000 if you're under 50, $8,000 if you're over 50, that's not a lot of money to put in, especially if you're starting out at zero. So it's hard to do alternative asset investing when you can only put in $7,000 or $8,000 a year. So 99% of our clients, and I assume clients of other companies as well that do the same thing, roll or transfer rather money from an IRA into the self-directed account because it's a bigger chunk of money to actually deploy into alternative investments. Okay. As you see the arrow going back and forth, all the income, all the expenses must go into and out of through the custodian. Okay. Now, with the custodial account, you go through the custodian for all investments. Okay. If you buy real estate, the custodian is on title. Okay. There's extra fees involved usually. Sometimes it's a flat fee that you pay annually, but oftentimes it's a per transaction fee. And so the custodial fee, and then it's time involved, right? There's extra time involved when you have to go through the custodian and say, hey, I want to buy this rental property. Can you write the check? Well, it starts out with, let's make an offer. Then it starts out with the earnest money deposit. Then it starts out with, then it goes to the down payment, then the closing funds and all that stuff, right? All that stuff has to go through the custodian, and the custodian makes those payments. So there's time and money involved in that. And so that's a duplicate slide. Sorry about that. Disadvantages of a custodial IRA, I kind of touched on these, so I'm not going to hit them again, but just know that there's a little bit of extra red tape and you just don't have as much control. So what we specialize in is the Checkbook IRA. So IRA LLC, or also known as IRA owned LLC. Okay, the LLC is actually owned by the IRA. So a special purpose LLC is created. This is separate from any other LLC that you might have. This is for the sole purpose of being owned by the IRA. And it has to have an IRS compliant setup and operating agreement, also known as plan documents. And this allows you, this LLC does, because you are the manager of the LLC, the fiduciary of the retirement account. This allows you to bypass the custodian when you're making investments and transactions. Okay, so here's a diagram of how it works. So you set up a qualified transfer from an IRA, 401K, 403B, similar to the custodial IRA. Then the LLC, special purpose LLC, is created, and you use that to open up a bank account. Now, all the income and all the expenses need to go into and out of that bank account. So when you see a bank account there, that is just a regular checking account, okay? So you can invest in as long or as quickly as it takes you to write a check. you have online bill pay options, you have, it's a regular checking account. So just think of it like that. Okay, so you open it up in the name of the IRS approved custodian, set up the qualified transfer, the LLC is formed. Now using that LLC, the bank account is opened up in the name of the LLC. That's what all investments will be made in, is the name of the LLC, as opposed to with the custodial account, it goes through the custodian as the name is named, right? So the advantages, of course, we touched on this a little bit, just a little, it's quicker, speedy transactions, low or fixed custodial fees. And then you do get some added protection from litigation with a limited liability company. However, we definitely recommend we don't recommend this from an official capacity, but being holders of real estate, we recommend having additional coverage as far as umbrella policies and such, in addition to just LLC protection, right? So what is a solo 401k? That's really what I want to spend a little bit more time on, just because we do think it is the ultimate retirement plan. However, there's nothing wrong with the self-directed IRA. It's just not quite as good as a solo 401k. And so the difference is it's a trust is created. Okay, so you're the trustee instead of the LLC. And it's really designed for self-employed or small business owners. It is designed for that. And it's not new. It's a traditional 401k plan that covers the owner and their spouse. Now, this was made possible not in 1974 like the self-directed IRA, but in 2002. So it's been around for a fair amount of time as part of the EGTRA tax law. And that law change made what we have now as a solo 401k possible. So how do you become eligible? Well, you need the presence of legitimate self-employment activity. Okay, anybody can do a self-directed IRA. That's why we do them, because anybody can do them. But with this, you need self-employment activity. Some examples are, we have a lot of clients, actually, we have clients in each one of these categories: doctors, attorneys, property managers, nurses. In fact, there's quite a few nurses that work a W-2 job, but then they also do some contract work on the side. Well, that contract work qualifies them as being self-employed. Fix and flippers, wholesalers, you can sell stuff on eBay or Amazon. In fact, the gig economy, DoorDash and Uber and those sorts of companies allow you to really quite easily become self-employed, because you're a contractor at that point. You're an independent contractor. And the other requirement is the absence of full-time employees. So if you have any employees other than you and your spouse, they can only work less than 500 hours a year, right? So roughly 10 hours a week. And as far as W-2 goes, we'll talk more about that. However, there are some excluded. Employees under 21 are allowed. And then I already mentioned under 500 hours, leased employees are not allowed. So like temp agency type employees, that's not allowed. However, what is allowed is independent contractors, 1099. And then, as I mentioned, it's designed for the self-employed individuals, small business owners without full-time employees other than their spouse. So here's how the solo 401k works. So the solo 401k plan it has to have a sponsor, right? So you have a plan sponsor. Hold on, sorry, I want to get them all up. So you have the plan sponsor, that's your business, okay? That's your legitimate self-employment activity. This can be sole proprietor, corporation, LLC, partnership, doesn't matter. That company sponsors and adopts the plan. The plan and the trust is created. And then the solo 401k trust is actually what holds the assets of the plan. And then you open up the bank account, just like the self-directed IRA with the LLC, you open up the bank account with the trust, and all the money, income, expenses, everything goes into and out of that bank account. So some of this applies to both the IRA and the 401k. You cannot commingle funds. If you hold a rental property, all the money to buy the rental property, to do the home inspection, any repairs, has to come out of the solo 401k or self-directed IRA account, checking account, and all the income has to go back into that. Okay, that includes if you sell it, goes back into that until it gets deployed, as I mentioned. Now, some more benefits of the solo 401k are as follows. So I mentioned $7,000 per year for the self-directed IRA. This is part of the reason we call it the ultimate retirement plan, because you can actually contribute 10 times In fact, if you're over 50, it's over $70,000, $76,500 to be precise, between the employee and the employer contribution. Okay, so I'm going to keep this as simple as I can, but think about a W-2 job that you have with a 401k. The maximum contribution for 2024 is $23,000. That's the employee side. Now, if you're over 50, you get an additional $7,500 on that. So now you can go up to $30,500 on the employee side, and you can contribute up to 100% of that $30,500 of what you pay yourself. So if you don't need that money to live on, let's say it's a side hustle to your main 9-to-5 job. Maybe you have a real estate license as an example, and you sell real estate on nights and weekends, but your 9-to-5 pays your bills. You're just doing the real estate job to make some extra money, save for retirement, whatever. Well, you could contribute all the money you make on that job on the employee side, up to 100% of it, right? Up to 30,500 over 50 or 23,000 under 50. Now on the employer side, that's the other part of it, which we'll talk more about. But that's how you get to the 70, is the difference between the 23 and it's actually 69,000 if you're under 50 is the max, but that's how you get to that. Proverbs 21:20 says, the wise man saves for the future, but the foolish man spends whatever he gets. Okay, contribution limits. So we talked a little bit about this, but just to show you on the diagram here, pre-tax or after-tax Roth is something I didn't talk about, and I will spend a second on that before I move off of this slide, because I want to touch on it for the self-directed IRA as well. On the employee side, you see right there, 23,000 plus 75 if you're over 50. And then the employer, or also known as profit sharing, tax deferred side, this is an expense for the business, the sponsoring business that you own that sponsored the 401k. You can contribute up to 25% if you're incorporated of what you pay yourself, and then 20% if you're sole proprietor or single member LLC of the net profit of the company, okay? And then that's where you get your total limit of 69,000 or 76,500. So regarding the Roth, again, another reason why the solo 401k is the ultimate retirement plan is because the solo 401k has a pre-tax account built in, but it also has a Roth built in, okay? One plan, two different accounts, and it's easy. You just have two different checking accounts. However, with the self-directed IRA, you can have two self-directed IRAs. But they're two different plans, right? So one could be pre-tax and one could be Roth, but they're two different plans. Okay, so that's two different sets of documents, two different, startups, establishment fees, and that sort of thing. But the 401k has it built in, so that's just another little advantage of the solo 401k. And then the other thing it has is a participant loan. This is not available with an IRA. So you're essentially creating a bank that will never turn you down. In fact, she actually happened to be a nurse, and this is a client a few years back that came to us, not a client yet, and she was considering, she had like $10,000 of high interest credit card debt she just wanted to get rid of. She had, I don't know, $30,000 or $40,000 in an IRA, and she had consulted with her CPA about taking an early distribution and paying off that $10,000 of high interest credit card debt. Well, the CPA said, well, you could do that, but you better take out 20 because of the taxes and penalties on top of that. Well, she had self-employment activity, and so she was able to establish a solo 401k, and instead of taking 20 out with pretty much 10 almost to go to taxes and penalties, etc., she only had to take out the 10, and she borrowed it, and then she paid herself back over the course of 5 years at an interest rate of prime plus 1%. So that's roughly 9.5% right now, because I think prime is 8.5 last I checked. And you can make those payments monthly or quarterly. And so instead of paying, Uncle Sam a bunch of money, she actually paid her own retirement account back. And so you can do this. You can access up to 50,000 or 50% of the account balance, the total plan assets, whichever is less, without taxes or penalties. And again, you're paying yourself back. And many people come to us, and I do have a couple slides on some examples of prohibited transactions. I'm not going to spend a lot of time on them just due to time, but I will touch on it because it's important to know. There are disqualified parties and prohibited transactions that relate to disqualified parties. Well, you can use this participant loan option to invest in some kind of transaction that would otherwise be prohibited. Okay, so you can invest in your own business to start that up, or to get more business, maybe marketing money, whatever. But you're a disqualified party to your IRA. But this loan this is your money. This goes into your own account and you use it however you see fit. You just have to set up monthly or quarterly payments. And if you use it for a personal residence, the amortization actually goes up to 15 years, not 5. So that can be pretty cool too. And again, this is not available with an IRA. So regarding Roth, we did touch on this, but the Roth contributions that come out of the employee contribution side, right? So 23,000 plus 7,500. There's no income limitation with this, like there is with a Roth IRA. And then all the incomes and gains are tax-free. I mean, the Roth is like the best thing since sliced bread. I think if people can start a Roth, the sooner the better, of course, because the more time that goes by, even in mutual funds, the more time that goes by, obviously, the more it's going to grow. But the annual limits are so low in a Roth IRA that, you know, it does take time to kind of marinate and bake and grow. Well, with this, of course, you can contribute a lot more, and by using your Roth to invest in like real estate, for example, it can be monumental. You know, the income and gains, they're tax-free. It's great. And then you can access the contributions at any time. So you have the participant loan, right? 50,000, but with the Roth IRA, because you already paid taxes on the contributions, well, you can access those contributions anytime. And then you can also do a Roth conversion. See your CPA about that if you want. It is a taxable event, but it's just that decision you make between paying taxes on the harvest or paying taxes on the seed versus paying taxes on the harvest. So you could take a traditional IRA, roll it over into your 401K or self-directed IRA, and you can do a Roth conversion on that and pay the taxes now, invest it, and then have it grow tax-free. So something to consider. Checkbook control, we talked about. It works the same way with the solo 401k as it does with the IRA. You're the trustee and you act quickly. This comes in handy, especially at if you do a lot of transactions, if you hold rental property and such. Of course, having checkbook control is going to be a big time savings and everything else. But if you go to investment clubs, a lot of our clients do, they go to regular investment clubs. Well, part of those investment meetings oftentimes is some kind of pitch for, you know, either a fix and flip opportunity or maybe a fund that you're considering investing in. Well, you can, obviously, you got to do your due diligence, make sure the person is worth their salt and you want to actually invest in them, but you could literally just write a check there on the spot and invest with them. You're in control, you act quickly. In fact, with the solo 401k, there's no annual filing requirement until you get over $250,000, and then you have to file what's called a short form 5500 EZ. It's 2 pages, and you're essentially putting on there what the beginning balance of the year was versus the ending balance of total plan assets, okay? And so it's when the end of the year it exceeds 250 is when you have to actually do that. We mentioned unlimited investment options. We didn't talk about precious metals, Bitcoin, cryptocurrency, you know, some of our clients like that. I would say primarily people come to us because they want to invest in real estate in some way, shape, or form. But I will talk about the prohibited transaction rules. As I mentioned, it's not an exhaustive list, but collectibles, think baseball cards and stamps and that sort of thing. And then life insurance and S Corp. Now, don't misunderstand me. You can, as an S Corp, can be the sponsoring business of the 401k, but S Corp, IRS guidelines is you have to be an actual person to be part of an S Corp. So your IRA cannot, or your 401k cannot invest in an S Corp. So that's why that's on there. But essentially, collectibles and life insurance are the only prohibitions. So disqualified people are the account owner and his or her spouse. Okay, you're one, right? That's what That's what Bible says. You become one when you get married, right? So you and your spouse are prohibited, okay? Now, think of a straight line up and down. Your parents, your children, and their spouses are disqualified people, okay? So brother, sister, aunt, uncle, friend, whoever is okay, right? Now, the other thing that is disqualified is entities in which a disqualified person holds a controlling equity or management interest. The rough rule of thumb is 50% or more, but I have heard CPAs and attorneys say they really prefer that to be closer to like a 30, maybe 40% ownership before you safely say it's okay to invest in that entity that is controlled by somebody who would otherwise be a disqualified person. So those are just some examples there. Common prohibited transactions are as follows. I am not going to go through all of these, but I will say, because you are a disqualified person, you cannot do any work on behalf of the retirement account, the IRA, the 401K, whatever. When you see IRA on here, the same rules apply to both the 401K and the IRA. And so a good example is, okay, I'm a real estate agent. I've had my license for 10 years. I cannot go as a real estate agent and represent my retirement account on a purchase. I can't do it. It has to be totally third party. Even if I don't get compensated for it, excuse me, even if I don't get compensated for it, I can't do the work on behalf of it. Now, when you own a property, the easiest way to think about this is if you buy a rental property, forget about that other example for a second. If you own that rental property already in the IRA or the 401K, you can't do any work on behalf of the IRA. That means you can't go to that rental property and change a faucet or swing a hammer or whatever. And that's okay. It's not a big deal. We just follow the rules and you can make a lot of money, right? I'm not saying that to discourage anybody. I just want to be clear about what kind of white collar work you can do, which is the behind the computer work. You can go, I've heard attorneys and CPAs say you can go open the door if someone wants to rent it, but you should really have somebody else do the paperwork involved in renting it and the property management and that sort of thing. It's just probably best to pay somebody else to do that. But you can't swing a hammer. You can hire somebody, a contractor, to go swing the hammer and that sort of thing. So think white collar work you can do, blue collar work you can't do. That's the easiest way to say it. And then just a couple more examples. You can't guarantee a loan. That's because we talked about the non-recourse loan, and then you can't use the IRA as security for a loan for yourself. And you can't sell personal assets to the IRA, right? So everything has to start out with, like if you're gonna buy a rental property, the property has to be purchased in the name of the IRA, LLC, or solo 401K trust from start to finish, right? Now you can do what's called an in-plan distribution, and you can take personal possession of that property if down the road you get to retirement age and you want to turn that rental property into your second home or personal residence or whatever. You can do an in-plan distribution, which is basically you're distributing that property to yourself. And that's a distribution. That's what it is. You can chunk it a little bit each year, so it's not a major tax hit all in one year, but consult your CPA about that strategy a little bit more if you're interested. And then, of course, we talked about not commingling the funds. Let's see. Yeah, we talked about this, but I'll just reiterate again, the Roth is amazing. Just all the incomes generated and gains are tax-free. Of course, it has to go into and out of, any income expenses have to go into and out of the account. And then if it's tax deferred, of course, they're tax deferred, right? The income and gains are tax deferred. So you pay taxes at a later date. Now, typically with the non-recourse loans, you're going to look at 30 to 50% down. The property, again, has to be the only security, and it's got a cash flow. I don't think the cash flow is like major, but it needs to have, $100, $200 cash flow each month. You do have to have a certain amount of reserves. I'm not sure exactly what that is, maybe 10% of the total loan amount. But you can check with Marshall Reddick, and then we have another URL there with a list of non-recourse lenders. But Marshall Reddick has done a great job for our clients as far as doing non-recourse loans for them, and they have competitive terms as well. Now, one other thing with the IRA that the solo 401k doesn't have is what's called a UDFI tax. So you'll pay if you have a mortgage on a rental property within an IRA, it's going to trigger what's called UDFI, unrelated debt finance income, and that's going to trigger a UBIT tax, UBIT, unrelated business income tax. Okay. Now, this doesn't mean that it's a bad idea to own real estate in your IRA at all, because it still can make a lot of sense. But you just have to know and do your homework on what kind of taxes you're going to end up paying when you have a loan on your IRA. Again, with the solo 401k, it doesn't have that. Now, solo 401k can have a UBIT tax, just not on leveraged real estate. And so that comes into play when the IRS deems that you're running a business in your retirement account as opposed to investing passively, right? That's how they level the playing field between, personal Joe personal down the street using his own money to run his business versus running a business in your retirement account. They level the playing field through the UBIT tax, which can scale up to 37%. So just something to be aware of. And then this is just a one pager on the IRA versus LLC versus solo 401k. I'm not going to go through all these, but I'll leave it there on the screen for a little bit so you can kind of see just a side-by-side comparison of the three different plans. Again, we only do checkbook control, so the two on the right are the ones we do, and then the custodial account we don't do. But those are the side-by-side on that. Obviously, the max contribution is probably the most glaring difference between the two different types, but that is that. And we're going to do some questions. By the way, I forgot to mention, I apologize. If any of you have any questions, hopefully I can't see the chat. I think Vince can. If any of you have any questions, type them into the chat. We're going to answer some questions for sure. That said, if you do want to get on my calendar, you're more than welcome to. You can go to that URL at the bottom and just book a call with us anytime, and happy to. It's totally free, complimentary, and just to kind of get to know your situation and talk through it and see what makes sense. And yeah, that's that. What questions do we have, Vince?
Yeah, so I'm often getting a handful of common questions, and I thought it might be good to cover a couple of those here on the call. One of those questions is, can I roll over my past employer's 401k into a self-directed IRA?
You can, yes, absolutely. In fact, it usually needs to be former employer. There are some rare exceptions where you're working for a company and they will allow you to take that money out of their 401k plan and move it somewhere else, but that is very rare. So yeah, 99.9% of the time.
That was actually tied into my second question. Was I get the question all the time. People get really excited about this and they have a 401k set up with their company, but they're currently working there. And the question is, can I roll over my current employer's 401k into a self-directed? And you just touched on that. And the answer to that is no.
Most likely.
Yeah, understood. You did a really good job covering this, but I do get this a lot just in case, is what else can I invest in with my self-directed IRA and 401k? And as you mentioned, it's not really a list of what you can invest in. It's more of the short list of what you can't.
That's right.
I could speak to this. I just feel like, having the ability to invest in the typical stocks and bonds and mutual funds are great. Direct loans, real estate, like you said, businesses, crypto, there's just so much, it's pretty much limitless. And, to have that capacity and be able to leverage that, that ability to, diversify so much within an investment, within a retirement account, I think is so crucial, because oftentimes those retirement accounts have such a vanilla kind of exposure, right? It's like mild, medium, or spicy kind of route you want to take, and it's pretty basic. And this gives you just so many more options. One other
Totally
question.
agree.
Yeah, one other question. Let's see. Can I have a self-directed IRA and an employer's 401k? So like a W-2 person with a 401k, and then have your own self-directed IRA?
Yes, that is possible. One thing I will touch on, if you have a W-2 job and you're currently contributing to the self-directed IRA, to the 401k, the employee contribution is per person, right? So if you're contributing $10,000 at your W-2 job and you open a solo 401k, then you're going to have 13,000 left over to contribute on the employee deferral side, right? Up to 23,000. But you can still get up to that 69,000 through the profit sharing side, because you could do 100% of the contribution on the 401k with the profit sharing side. You don't have to do any of the employee deferral, but that's just kind of how that works. It's the employee deferral is per person.
And just to make sure I understand that correctly, as far as you kind of mentioned solo 401k, but in a self-directed IRA, my max is 7,000, right? So let's say I wanted
That's
to
right.
make that contribution of 7,000, but I also had a employer's 401k. How much could I then contribute into how does that 7,000 contribution into my self-directed impact what I'm able to contribute to the employer's 401k?
Yeah, it doesn't.
Okay,
It's totally separate.
cool. And then last steps is, where do folks, get started to setting one of these up?
Yeah, no, great question. You guys, anybody on the call, I welcome you to, if you don't want to book a call right now, that's perfectly fine, no pressure whatsoever. But just go to our website, sensefinancial.com. There's 2 drop-down menus you'll see in the top right. There's IRA, self-directed IRA is the first one, and then solo 401k is the next one. I would recommend just clicking those drop-down menus, and there's a couple videos which are essentially the same thing we just went through, but in case you want to watch it again, I'm sure you'll get this recording. And then there's some helpful other links there about the process and the setup and all that. So you're welcome to do that as far as due diligence goes and learning more. But again, my offer to you is set up a free consultation with us and let's jump on a call. Furthermore, I didn't say this, but I will. Dimitri, the founder of our company, actually wrote a free ebook. So you can go to sensefinancial.com/IRA makeover. It actually talks about the IRA and the solo 401k. And that's another way to not just listen to someone like me rail on about it, but also read through, an ebook that somebody wrote that's been doing this at a high level for a lot of years. So I would kind of make that offer as well.
Yeah, awesome. Brett, thank you so much for taking the time. This has been super, super helpful. And guys, like I said, I'll be doing some follow-up calls. And if you need any assistance in connecting with Brett or the Sense Financial team, I'm happy to facilitate that and put you guys in emails. And, once it's all set up, that's where we at Marshall Reddick have an opportunity to explore some of those options, whether it's note investing or real estate acquisitions or whatever that may be. So again, we want to thank Brett so much for your time tonight, and want to thank all you folks for joining us this evening. We really appreciate it, and we definitely look forward to chatting with you guys soon.
All right. Thanks, Vince. Thanks, everybody.
Thanks, guys.